All right, what's going on, everybody? About 1 hour away from the market closing here on Tuesday, November 11th. What is going on in the markets today? Let's pull up the charts. NASDAQ is a little bit down. S&P 500 is a tad bit up. The Dow is performing really well today. It's up 1.2%. Russell 2000 up just a tad bit, basically flat. Gold is pretty much flat. Bitcoin is down, and we've got long-term rates are up. Let me know if you guys can see and hear me all right in the chat. Okay, looks like we are firing on all cylinders. Okay. All right, go ahead and throw any questions that you guys have in the chat. I'll try and answer as many of them as I can. We will be looking at what's going on in the market here. Everybody looks like the things that they're focusing on today are fake jobs, fake job, what's it called, listings, where companies will post jobs that are not actually available. Part of that might be to give the impression of growth, like they're hiring, but they have no intention of actually filling these positions. When do you think the big liquidity pump is coming? I don't really expect a big liquidity pump. Obviously, if we get like the $2,000 stimmy checks from the tariff refund, that's going to be something that will juice the markets. I don't think it's going to happen that way. I don't think there's going to be checks. At most, I think it'll be some sort of a tax deduction or tax credit. And it'll probably, well, it could be refundable, it could be non-refundable, which means like, let's say there's a $2,000 tax credit as a tariff refund, and you owe only $1,000 in taxes. Refundable would mean that not only do you not pay the $1,000 that you owe, you get $1,000 back because it's a refundable credit. Non-refundable credits are like it'll wipe out what you owe in taxes, but it won't go past that. So if you only owe $1,000 in taxes, then it would take it down to owing nothing, but it wouldn't give you an actual $1,000 check after that. I think at most that's how it would be if it happens. It's probably not going to happen though. And so in terms of like a big liquidity pump, I'm not expecting a big short-term liquidity pump. The Fed on December 1st, so just a couple weeks from now, is shutting off QT. They're going to still wind down mortgage-backed securities and roll that money over into T-bills. So that will be a modest boost in liquidity. Government shutdown ending will return that liquidity to the market. But I don't expect like one big. It's not going to be like a 2020 type of event or anything close to that. So just going to be transitioning from tighter environment with liquidity crunches to easier environment without those liquidity crunches. What do you think of the private credit market? Depends on what you mean by the question. I don't have a lot of strong opinions on it. In a falling interest rate environment, I don't see any problems that are like big enough to potentially spiral out of control. There are, from what I can tell, some pretty large unrealized losses across the private credit markets. But again, I don't think it's something that presents any systemic risks. All right, can I start with gold? What are some supply chain assets that are worth the effort to vet or invest? I'm assuming you're asking about like starting off with investing. So the way that I look at gold is that it's a savings account. It's a true savings account. In other words, it'll preserve your purchasing power. So a lot of people standard advice in terms of like your investing, order of operations, the steps that you should take. Number one, save up an emergency savings account, and that should be in the currency that you owe your bills. Because if surprise bills come up, they're not going to be asking for ounces of gold. They're not going to be asking for sats or Bitcoin. They're going to be asking for a certain number of dollars, or if you're overseas and whatever your currency is. Um, and so your emergency savings account needs to be denominated in whatever emergency might come up. Once you've done that, then it's like, okay, well, are you going to pay down high interest debt like credit card debt? Usually that's a pretty good next step. A lot of this is basically like Dave Ramsey stuff, but he's been the biggest popularizer of this kind of order. It's pretty common, so it's not like he's got an odd idea here. So paying off that super high interest debt that's just costing you money, like if you pay off 18% credit cards, that's an 18% return to you. It's the same thing as getting an 18% return in the market. It's just you stop bleeding that instead of, so same thing. So pay off that high interest debt and then save up like a 6 month, 6 months worth of expenses savings account. And if you want to put the majority of that in gold, like, personally, if that was me, I wouldn't put it all in gold. But I wouldn't mind keeping a chunk of it in there because over the long term, I'm not planning on using this, which means I want it to maintain its purchasing power. If I put it in a high yield savings account, that'll do well. It'll probably still bleed a little bit. If I put it in a money market fund or something like that, it'll probably still bleed a little bit to inflation. So I wouldn't have a problem putting a good chunk of that in gold because it'll preserve your purchasing power over the long term. A lot of people do say you need to save up a big chunk before you invest in anything because the returns that you get on, your early investing are not gonna really do anything. Math wise, that's correct, but habit wise, I think it's very important to start investing early, even if it's $20 a month, $30 a month, because, like, for example, when my wife and I got married and we put her entire, or was it her entire salary? I believe it was her entire salary or my entire salary, one of the two. I can't remember now. Towards getting out of debt, and we got out of debt within in under a year. That discipline itself is like ultimately that wasn't there's not a whole lot of math that went into, okay, well, like if it takes us 1 year or 3 years or 5 years to get out of this debt, it's like you could have invested along the way and probably made more money because our interest rate wasn't super high. But that discipline then prepared us for when our first kid came along and she stopped working. We were already used to having a very tight budget, just living off of my low salary because we had built that discipline and built that muscle already. And then once I started making more money, we had already built the discipline and the habits of living on a small amount of income. We could invest rapidly with a bunch of excess income, and we didn't have a bunch of large expenses. And that ultimately is what allowed me to quit my job and start Heresy Financial back in 2019. So anyway, I don't think a lot of these things, especially early on, they're not about the investment themselves. They're not about the amount itself. They're not about the dollar amount per month or the specific investments that you're choosing or anything like that. A lot of it, especially early on, is habit building. Those habits are what are going to compound and spiral into big wealth building later on, not the precise choices. So it's more important to do it and then improve later rather than wondering and worrying about what exactly you should do. Just start and then fix it later. What are the odds we get another Operation Twist 2.0 and the effect it could have on long-term rates, in your opinion? It's essentially what we have starting in December. Operation Twist is just the Federal Reserve changing the composition of its balance sheet. So if the balance sheet isn't moving, which it's not going to, that's what they announced starting December 1st. Our balance sheet won't be increasing or decreasing anymore. It'll stay the same. But on their balance sheet, they hold treasuries and they hold mortgage-backed securities. They're going to still bleed off to mortgage-backed securities, and they're going to buy more T-bills. That is Operation Twist, 3.0 or whatever. And so that will just allow the government to borrow more, borrow cheaper, and spend that money, borrow that money into into existence. So it'll be overall a rising pressure on money supply, um, and potentially inflation as well. For long-term rates, oh no, did I just delete that comment? Oh no, I didn't. Okay. For long-term rates, the impact that that would have on it will be like, because short-term rates are going to be going down from that because the Fed is buying more T-bills, so that'll help keep short-term rates low. But depending on inflation and growth, if that doesn't go the way the market expects, that actually pushes long-term rates higher. Um, for anybody who is buying and selling long-term bonds, now you have to account for the higher inflation. Um, so I think the yield curve will probably steepen over the next couple of years. Do you think the real estate market will boom again like in 2020? No, I don't think it'll boom again, but I definitely, in my opinion, don't see really any catalyst for any sort of a crash. We've seen prices decline, especially rents and multifamily, in many cities across the country that allow building, which makes sense. If you allow new supply, prices will be able to go down. Um, and it's like, shocker. Like, if you want to fix affordability, let people increase the supply. Um, but overall, real estate prices have kind of flatlined, um, and the demographics are the biggest reason of that. The number of people who need a place to live versus the places that there are to live, and in most major cities, that ratio is not getting better, and um, there's nothing happening right now that will make that better in the future. So my best guess over the next, let's say, 5 years is just a slow increase in housing prices, unless we get something like, okay, 50-year mortgages come in, boom, that'll be an instant boost because it just allows people to afford, um, a higher house price for the same payment. So it's artificial demand increase that juices prices. Um, the other thing is if they try and uh, manually force interest rates lower on mortgages, that will also do the same thing. Okay, when are we going to bounce back, man? Can you inject some liquidity into the market so my swings start making printing until Christmas? Well, depends on what you're trading. I mean, let's take a look. Okay, so the NASDAQ is currently down 2.3% from its all-time high. And the S&P 500 is down 0.95% from its all-time high. I mean, what do you mean bounce back? Like, look at this. Like, so maybe you're trading something that has not been following the market super closely, but the market overall looks like it's already bounced back. I mean, we're very close to the all-time high right now. What are your thoughts on investing in U.S. rare earth critical mineral stocks? The government seems to be investing in private companies, knowing that China's global leverage. Maybe it's coming. Yeah, I'm very bullish on commodities, rare earth magnets, minerals, critical minerals, energy, industrial metals, precious metals. Very bullish on all of that. In fact, one of my investment research services is Resource Breakout Alerts, where I go over the technical analysis and the charts for commodity and energy resource related stocks that are experiencing some sort of technical breakout. Send out alerts for it. And I don't send out alerts for anything that I'm not investing in myself. So yeah, I'm very bullish on that right now. Have you heard of XRP and XLM? XRP, yes. XLM, no. I'm not a fan of any cryptocurrency other than Bitcoin. The more I learn about Bitcoin, the more I like it. The more I learn about every other cryptocurrency, the less I like every other cryptocurrency. Is GLD okay instead of physical gold? It's okay for price, for simple price exposure. And for, 99% of the possible futures, that's all you need. So yes, GLD will give you the price exposure. So you got your money locked away in a 401k or something or an IRA, then that'll be fine. The situation which GLD is not okay is the like the all hell breaks loose type of situation where it's like you need your physical gold because GLD will just, you know, in a situation like that, let's say, big nuclear war across the world, or something knocks out the internet everywhere, and just crazy like apocalyptic future type things, you would need physical gold. They wouldn't do you any good to have shares of GLD. It would just be like nothing, like you didn't own anything. Um, and so if you have physical gold, then you actually have it. And then you can use it for, barter and exchange, and use it as money in a post-apocalyptic world, trade it for things that you actually need. But yeah, for apart from those kind of futures, there are very few scenarios in which GLD would not serve most of your needs. So I do like using GLD to trade because it's super convenient, super cheap, super easy. All the tracking is done for you inside your brokerage account. But I use physical gold for like my long term gold holdings, and that is not real. This man, let me. How do I point to that? That is not real. That would be like, I don't know. I haven't counted it up lately at $4,000 an ounce, but if that was real, that would be like, I think like $15 million worth of gold. So that would just be incredibly reckless to have. Those are like $30 plastic props from Amazon. I think they look cool in the background of my videos. So the gold, I think it would be reckless, and there's many people who like, you can't store physical gold at home because maybe you travel a lot, you're in a apartment complex where you can't hide something inside the walls or whatever, other situations like that. So if you're in a situation where it would not be safe for you to store physical gold yourself at home, you get a vaulting service where the gold is allocated, segregated, insured, independently audited, and ideally in a country without any history of confiscation and a high degree of economic freedom. That would be like Switzerland and Singapore. All right. I have a question about your approach to investing. Do you prepare a list of interesting companies in advance and set alerts to enter when they're undervalued? And then for valuation, are you using PE ratio? Um, I tend to lean more on technical analysis rather than fundamental analysis for most of my trading. My long term holdings, those I will lean more on fundamental analysis. I've got a couple uh, very basic value calculators that I've made that I use. Those are available in my program as well. And they're just very basic stuff, like looking at history of growth of revenue and earnings, and the market's valuation on those profits. So yeah, PE definitely goes into that. In terms of looking at companies that I'm interested in buying or interested in trading, I have watch lists, and so I'm constantly, cycling through my watch lists and looking for opportunities. And I think watch lists are probably the best for my preference way to do that, because then I can continually, be checking on them and just, every day scroll throughout every stock on all my watch lists and see what's going on, both with the news and the charts and everything. Okay. Do you think a payroll service that pays instantly rather than weekly or biweekly would do well in today's world? Um, I don't. That's a good question, because a lot of this is where like momentum comes into play. So this might be an odd analogy, but um, actually, I don't want to talk about this on YouTube. They tend to not like. I was gonna make an analogy with pew pews, but YouTube doesn't like people talking about that. So I'm gonna use a different analogy instead. Um, the reason why we use gasoline in cars because back when Henry Ford was trying to, before he got the Model T up and running, and he was experimenting and building and stuff. Rockefeller went to him, and Henry Ford was using a different fuel initially, and it worked better. And I'm using this from memory. This is from the book. It's not Titan. It might be Titan by Ron now? Yeah, I'm looking at my bookshelf behind me. I believe it was Titan by Ron. I've read a couple of Rockefeller's biographies, and I think it was in this one. Henry Ford was using a different fuel that worked better, but Rockefeller went to him and said, "Hey, look, we're refining all of this oil, and we have this waste product called gasoline that we're literally just dumping on the ground. Like we don't have a use for it, but it could be used as fuel in your engines if you redesign them." And so he convinced Ford to use gasoline because he was like, "Look, it's super abundant, it's going to be super cheap, it's a waste, right? It's a byproduct right now that nobody's using right now, and it'll help you sell cars." And so technically something that might have been an inferior thing ended up being the dominant thing that just basically took over the world. And so um, the daily paycheck thing versus weekly paychecks or biweekly or semi-monthly, um, the it technically might be better, but because there's a lot of momentum behind and people being used to using something like semi-monthly or biweekly, but or the opposite, semi-weekly or bi-monthly, I don't remember which one. Um, Means that people are very used to getting paid, and they schedule their like large payments right after they get those their paychecks. And so opting for a system like that would make people have to do a lot more planning. They'd be like, all right, well, I need to get paid like 13 days in a row now before I can have my rent charged to my account. And that means I can't spend like it would be very different than what most people are used to, and most people are not very good at future planning, especially with money. So I would imagine that it could make people overdraw their account fairly often. All right, let's see. Um, we just had several solar flares, minor outages expected in the next 24 hours. Well, if anybody's going to have an outage, it's going to be me. I don't know if you guys have been on any of my past live streams over the last couple of weeks since I started doing this, but man, any internet outage that happens in the world hits me first. And so if you see any glitches today, I'm going to blame it on the solar flares. um, can you break a 1 ounce coin into $5? LOL. I wonder, I'm not sure if you're talking to me or if you were talking to somebody else and responding to somebody else. But maybe you were responding to what I was talking about earlier about gold being used in like a post-apocalyptic setting. The answer to that is yes. So imagine you have a 1 ounce gold coin that's currently worth $4,000 in today's money. So you're not gonna like precisely take some like I don't know, clippers and cut out a little chunk of it that's going to be exactly $5. But you could shave shavings off of it that would be worth $5. You could melt it down and mix it, dilute it with other metals to make a larger chunk that would be able to be more precisely divided into smaller amounts. It's literally what humans have been doing for all of human history. It's not that complicated. So yes, if we go back to a world where we're not doing global transactions because there's no internet and there's no global trade happening, and people need to start using a better form of barter commodity money again, then it's not that hard, which is why humans did it for thousands and thousands of years. All right, let's see what's the next question. Um, if you need to move and you have physical gold, would it be possible to take gold with you to your destination country? Probably not, actually. So this is why I always recommend storing your gold in a different country, especially for those of you who live in the U.S. or live in England. I don't think it's smart to store your gold in a country with a history of gold confiscation. It's like if push comes to shove and you're trying to flee, you're not going to be able to take it with you, and that's assuming they haven't already taken it from you. Um, and so I don't think it's smart to store your gold for I'm not talking about like all your gold. I'm just saying I think it's a good backup plan, a good idea to be a little bit diversified geographically, to have some gold stored in a different country that doesn't have a history of stealing gold from its citizens and stealing gold from the rest of the world. Um, but let's say you can't do that for whatever reason, then you sell your gold. You have the cash, and you go with that. You maybe you sell it and then buy it in a different country online first, and then go. Um, So gold is a very, very liquid market. It's just if push comes to shove and you're trying to escape, you're probably not going to be able to hide it on your way out. Let's see. What are your thoughts on gold back foil notes? They're just I, the, at best, they're a future collectible. The technology required to make them will not exist in a world in which we would go back to using gold, like physical gold, as money. So at best, they're a future collectible. I have some. I think they're cool, but there's no future in which I can see that people, because it's impossible to use physical transactions of money for any sophisticated large scale economy. You need electronic transfers of money. And so if gold is going to become money again in a dynamic economy similar to what we have right now, it's going to be the ownership of gold that changes hands, which means gold is in storage, um, not by governments, but by free market, private companies. Um, and the ownership of that gold changes hands electronically. When you swipe your card or when you make an electronic payment, the gold in the vault stops belonging to you and now it belongs to the next person. A lot of people think, hey, that's never going to happen because that's how it started off and that ended up in government control, and that's fine. It might never happen again. But if gold becomes used as money again, that's the way it will happen. Again, unless it's like an apocalyptic world. Because you can't just buy billions of dollars worth of supplies from another country, and spend all that money on securing and shipping all of that heavy metal in order to make payment every time. It's the reason why paper was invented in the first place. Um, and that's even more of a need today than it was hundreds of years ago when paper was invented. Okay, let's see. Do you see an opportunity to bet against Apple with a put right now? I don't. So just so you guys see here, um, just for full disclosure, I'm neither long nor short Apple right now, either through shares or through options. And the reason why is because I have not been able to identify a good trade here. So Apple is obviously performing very, very, very well. Berkshire Hathaway dumped most of its, I think half of its position in Apple right somewhere in this period. And Apple tanked from its top here to its bottom here. Is down 35%. But since then, it's fully recovered and is higher now. Now, one of the things here is that Apple looks like it's facing some headwinds, um, but it also buys back a lot of its own stock. In fact, at the current pace that it buys back its own shares, and at the current pace at which its shares that are outstanding have been declining, like it is actually possible Apple takes itself private by the year like 2035. So that kind of buying, fueled by its profits, is something that is going to continue to be a bullish pressure on its shares. Um, I mean, they've got a lot of cash and they've got a lot of room to borrow. So even if their like revenues and profits start to suffer because of overregulation and lack of innovation and things like that, so I've not been able to find a good trade, both either bullish or bearish on Apple because of those. It's like I don't really like Apple as a long-term buy. I don't really want to short a company that's committed to like buying up all of its outstanding shares either. So I don't have a strong opinion on Apple right now either way, which is why I don't have a position on it. Okay, let's see. Is buying options even worth it for the retail investor? I get that they're good for downside insurance, but outside of that, isn't it just a crapshoot unless you have the kind of info that big money has? Um, no. I mean, if you don't know what you're doing, then yeah, it's safer to buy shares. You'll have just the return of whatever those shares produce for you. If you're sufficiently confident in your analysis of a stock that you're buying something, let's say at a good value, and it should be valued higher in the future, then assuming you're right, you will have a better return on that position by using even something as simple as like an in the money call option versus just buying the shares. So it's options are just inherently, because they're contracts, they're higher leverage in terms of both the gain and the loss on them. So if you're right, you'll make more. If you're wrong, you'll lose more percentage wise. But you can through if using options correctly, you can actually limit your risk because it's easier to control your position sizing and make it smaller. So if you limit your downside risk, you're actually able to take more chances of making money. This is like this is the misunderstanding with what risk is. A lot of people define risk as volatility. Well, that is an incorrect definition, because many times things with low volatility are just actually hidden risk. So you look at something like the value of gold or the dollar price of gold for decades was $35 an ounce. But that wasn't the real value. The real value was being artificially suppressed by law. And eventually it broke and all that volatility exploded all at once. And the dollar's value tanked versus gold. And so low volatility oftentimes can just be suppressed risk or hidden risk. High volatility, on the other hand, shows you that the market is actively and dynamically trying to reprice this thing to find its correct value. So high volatility can show you that you can show you what the true risk is. When you know what the true risk is, then you can manage it and you can limit it for yourself. One way to do that is with position sizing. And so let's say the maximum you want to lose on your portfolio is 10%. Well, if you put your whole portfolio into something, then you can you set a stop at 10% on that one thing. Then worst case scenario, let's say you lose 10%. Alternatively, you could put 10% of your portfolio into one thing, and then you could just sit that thing out to zero. Because then worst case scenario, let's say 90% in cash, 10% in one thing, worst case scenario, you still only lose 10%. So that's a weird extreme example, but you get the point that you can control risk multiple ways. And by making your position sizes smaller, you can control your risk even better. And the extreme of that would be you have positions where if the position goes to zero, you lose 0.1% of your portfolio. So by doing options, you take small positions that are high risk, likelihood go to zero, but if they pay off, they're super leveraged, so they pay off really well for your account. They can make a meaningful impact on the upside because upside is unlimited, but they can't really make a meaningful impact on the downside because the most they could impact your portfolio would be like losing a small amount because that one little position goes to zero. So it just depends on how you use them. You have to be educated. You have to use them correctly, but it's not something that is, off limits for retail or useless. All right. What do you do if you have parents that just won't listen? I'm 20. My parents don't seem to understand what I'm telling them, but my dad seems more convinced to buy real estate. Well, okay. So two things here. Number one, you're 20. So you need a disproportionate amount of evidence that you know what you're talking about in order to convince somebody who has 40 more years of life experience than you. And in fact, probably, I don't know how old your parents are, but like the first 10 years of your life, first 15 years of your life probably don't count as life experience in the eyes of somebody who is like 50 or 60. Because like you were a kid, you were just, going to school, like you weren't learning anything about investing or anything like that. And so that doesn't mean uh, that you can't be influential. It just means it's a lot harder. You need a disproportionate amount of evidence to overcome those biases. And the harsh reality is that you might not be able uh, to present that evidence. Like you may not actually have the proof or the evidence that you know what you're talking about. It might take 5 years, it might take 10 years, it might take longer before you have the proof to say, hey, look, I do know what I'm talking about. I was right all along. Um, so that's the first thing is that I wouldn't feel discouraged about that. It's just like you wouldn't listen to a 10-year-old about the same things because you would correctly assume that they know less than you about that topic because they have had less experience with it. Um, the second thing is, personally, I don't think there's much wrong with the idea that I'm going to invest in more real estate. I am not bearish on real estate. And in fact, if somebody has spent an entire career investing in real estate, they likely know what they're doing, which means even if there are troubles in the real estate market, they will know how to navigate them because they've navigated troubles in the real estate market before. Um, Finally, the last thing I would say is, like, I have a lot of trouble convincing my parents to do things. Less trouble today than I used to, but just for example, I'm going to show you a gold chart. I told my in-laws to invest in gold in 2017. It was around $1,200 an ounce. In August of 2020, they finally said, "Okay, we're ready to start investing in gold." You see, that was the top. And then that's when they started buying. And then in November of 2022, they said, "Okay, we want to stop buying gold because it's just been going down." So they lowered their average cost to like $1,800 an ounce. Well, then in March of 2024, because of a real estate thing, they needed cash. So they decided to sell all their gold. So they made like $200 an ounce on it. And literally, that was the month where it started its huge extra run. And I have this circle here to show you that is when my in laws texted me and said, "Hey, we'd like to start buying gold again." Um, Now, if you know anything about me, you know that I I definitely told them to not sell their gold and to never stop buying it. Um, And so just because you know you're right about something, just because you have the evidence to prove it, doesn't mean that you can control what other people do. And in fact, you have a lot less influence over anybody than you probably think. I think that most people will not change or do anything unless they internally want to. That it's impossible to convince anybody to do anything. Um, and so I view my job as having the evidence ready for when somebody asks because they're already ready to. They just need the the information or the guidance on how to do it. Um, I don't view myself as with anybody in life having my role be trying to convince them to do something different. Um, so it's probably not what you were looking for, but that's my opinion on it. What do you think about Berkshire Hathaway? I love Berkshire Hathaway. If I like honestly, if I could only buy one stock and I then the market was going to shut off for the next 50 years and I literally couldn't touch anything. And I had to do my entire net worth and I could only buy one thing. It would be a difficult decision, but it would be probably Amazon or Berkshire Hathaway. Right now, if you made me choose right now, I'd probably lean towards Berkshire Hathaway just because there's more. It's like the Lindy effect. There's more history behind that. Probably wouldn't be as good of returns, but it would be safer. There's less chance that I think it would go to zero or lose money. So I love Berkshire Hathaway. I don't think it matters at all that uh, Warren Buffett is retiring and close to probably close to the end of his life. I think he's done a very good job of passing on his systems and his knowledge, and the company is going to do well for a very long time. Do you ever sell your gold? When you sell your gold, do you have to pay taxes on the capital gains, even though you just wanted to preserve your purchasing power? The government seems to want. Yes, if you sell gold at a gain, it's an asset, it's a capital gains, and there's going to be capital gains tax on that. So be very mindful about selling your gold. That doesn't mean it'll always be reported. Some companies, depending on the way that you sell, will not report it. Like they're not going to send you 1099 or anything. But if the IRS finds out that you had a capital gain and you didn't pay taxes on it, then you'll be in trouble. So yes, you do owe taxes on gold if it has gain. That's one reason why I like the company Monetary Metals, which allows you to lease and loan out your gold with gold bonds and gold leases, because it allows you to take profits from your gold without selling it. The other thing is, I don't actually. I stack my gold holdings, my long-term gold holdings. So I don't sell that. I don't trade that. I'll trade gold in like my trading account. A lot of times that's done with like GLD. But in terms of my long-term gold holdings, I'm not going to be trading that or selling that. Let's see. In some states, there's no capital gains with gold, but that's just at the state level. You still owe taxes on that gain for your federal taxes, regardless of what state you live in. Okay, let's see. Very good explanation on security using options. Thank you. I've been an options trader for, I don't know, at least a decade now. And for the first couple of years, I just had massive losses, just one after another. Like I'd build up my account, build up my net worth, and then boom, it's like first time is like 90% of my net worth wiped out. Then build it up again, and then boom, 60% of my net worth wiped out. And then build it up, but like it was just it was a long, expensive, gut-wrenching process of doing the wrong thing over and over again, learning slowly and painfully the right way to do things. So I really hope that anybody who is listening during that part, or if you go back and watch the replay, you take that to heart, because I'd rather have you learn from my mistakes and not have to go through those painful, expensive lessons yourself and be able to just start making money, rather than having to learn those same lessons yourself. All right, let's see. Howdy, have your own kids. Oh, I bet you are. I think you're responding to the question about your parents, his parents. Okay, let's see. I've read Ludwig von Mises books, Adrian Day, Peter Schiff, Rick Rule. I've read Creature from Jekyll Island. I spend a large time listening to you guys. I can articulate my point very good, by the way. Thank you for answering my questions. I've been saying bye since 1750. I'm assuming you're talking about gold, since you said 1750. If I were in your position, I would probably approach it from a standpoint of trying to show them what convinced you. So instead of trying to convince them yourself, like if they read books, give them a book. If they listen to audiobooks, give them an audiobook. If they watch YouTube videos, start sending them YouTube videos. Because they're probably, if they haven't listened to you by this point, and you don't want to wait the years and years that it might take to develop that credibility yourself, you might want to just share with them the sources that changed your mind. Can you look at MSI, please? Let's take a look. I don't know what MSI is off the top of my head, but we can take a look. No, it's not going to pull up. It did pull up. Okay. All right. So number one, this looks like a very precarious setup to me. We've got this nice little support line that it does seem to be holding at right here. So I'll zoom in. It's holding there, which is good. We want to see this hold. And it was support and resistance here, and then support here. Um, if that breaks though, then you've got a long way down to go. We could easily see this thing. There's not that much price action in between where it's at right now, and probably 300 would be the next strong level of support, and then 272 would be the next really strong level of support after that. We also have this. So personally, if I was going to trade this here, I would, trading inside this channel, I could go long here and then sell when it reaches near the top of this trend, play the inside of this channel, probably bounce along inside of here. The one thing I want to make sure I do is control my risk. Like I'd probably set a stop, like maybe at like 380. That way, if it does slightly dip below and has a false breakdown and then pops back up, I don't get whipsawed. So if I'm buying the shares, then I might set a stop at like 380. If I'm buying a call here, then I might also, buy an out of the money put here that's cheaper, in order to capitalize on it going down as well if it does break. So it is precarious right here, but it looks like it has done a good job of holding support there. So playing that back to the upside of the channel is probably a good trade as long as you're managing your risk really tightly on the downside there. All right. Copper, love copper. In fact, COPX is a copper mining ETF, and they've got a pretty good setup right now, waiting for a breakout, but they've got a nice little bull flag on their chart right now. Let's see here. I've been accumulating forest land instead of gold, buying them at tax sale at half or less than half the market price. Okay, so I'm going to assume you know what you're doing here. And I'm going to assume you've got a lot of experience and a lot of years behind you. And if so, then that's great. If you're new to this, the red flags that stand out to me with that are, number one, how do you know that you're getting it below or half what the market price is? Like, have you actually flipped it and been able to sell them? And if so, again, like I said, I'm assuming that you know what you're doing, and so that's fantastic. Keep in mind though that this is like it's a trading thing. You're not purchasing cash flowing assets here because this is forest land, and so I'm assuming that it's just like you'll owe taxes on it. So it's a while you own it, it's a liability. It's not producing cash flow for you. Unless you're leasing out the land, unless you're doing stuff with it and you're producing cash flow again, that's something that you can absolutely do to make money on it. I also wouldn't consider that as something to replace gold. Like gold is a savings account. So assets or investments and savings, or what I like to say is reserves. There are different parts of your portfolio for different purposes. So one of reserves is like your cash equivalents, your gold, your Bitcoin. Those are the things that you use as money, as savings, so that you can buy assets when they're on sale, you can rebalance when necessary, and that if everything does start to crash, you can use that for liquidity and you don't need to rely on selling assets at a bad price. So that's what the reserves portion of your portfolio is for. Buying, flipping forest land, leasing it out, doing things with it to make money, that is an investment, potentially an active investment. And so it's in a different category of your portfolio. Thanks for answering my question about options. I'm just getting into learning about trading. Yeah, my pleasure. Let's see here. MP and UU stock are down significantly after you recommended those two stocks. Okay, a couple of things about that. Number one, I don't recommend or advise. I am not a broker. I'm not a financial advisor. What I said about those stocks in my event was these are two stocks that I am very bullish on over the next 5 years or so. And that has not changed. And if you expect that there won't be downturns after big run-ups, then you shouldn't be investing. And so I'm still long those positions, and I haven't changed my mind about them because the fundamentals haven't changed. All right. What's going on with BlackRock and corporate defaults? I don't know. I saw that question come up a couple of times and I didn't answer it because I don't know. I don't have an answer for you. So sorry. Um, do you do back testing for option strategies? No. I've tried a couple of times to get some uh, trading bots, some do some some trading algos, things like that. What I found is it's when you do that, you're trying to you basically it's very hard to avoid overfitting. So you go through all of the data and you develop a strategy that would have worked. And then once you implement it in real time, it's like a lot of the what would have worked happened just from coincidence, and the correlation at some point stops. And so I've tried that with a portion of my portfolio, spent a good probably $60,000 to $70,000 with hiring programmers to build out different programs for me because I don't know how to code myself over the course of I don't know probably a year and a half, and the long term results are just not worth it. Not anywhere near profitable enough to make it worth it. So I don't do that anymore. I've experimented with it. I've tried it. Probably was doing it wrong, but I don't have the people or the I prefer active investing myself. And so I don't really do it. A lot of what I do is macro, fundamental, technical, and then I'll just do the math on which options have the best risk to reward profile for that position. So based on the overall market, based on the industry, the sector, the stock, and based on the chart, am I bullish or bearish? Okay, where do I think the target's going to be? Okay, do I have a good profitable setup by choosing, a certain expiration date or a certain strike price? If I think it's going to go from 100 to 200 in this time frame, is there any way to have a good risk to reward profile on any option trade, or is that movement potentially priced into the options premium already? Most of the time it is. So most of the time it's just all right, move on to the next. Okay. If the market shoots up tremendously because of very low interest rates under Trump's influence, would this cause a lost decade for gold? I just don't want to be locked in at this level at 4,100. Gold usually anticipates monetary policy. And so usually you see big run-ups in gold happen before the impacts of easing hit the rest of the market. I think we've probably seen most of that happen already. And so just like gold ran up until August of 2020. And that was before CPI moved. That was before markets topped out. The stock market topped out, and gold just went sideways for a couple of years from there. And so I wouldn't be surprised at all to see something like that happen again. It's like more easing is coming, but gold already made its move to front run that, and you could very easily see gold move sideways as the rest of the market catches up and CPI starts to move, and the easing cycle hits. I wouldn't be surprised at all to see that. But the thing is, gold, I look at it as a savings account. Like even if you bought gold at 2,000 3 years ago, now you're sitting on $4,000 gold. So you're like, oh, I doubled my money. It's like, well, your purchasing power didn't double in that time. It's a savings account. You've preserved your purchasing power over the long term. So I'm never one to look at gold as like trying to time it. It's like, okay, here's my savings account. I'm going to put my money in it just to preserve my purchasing power. And if you're really worried about it being a top, you can dollar cost average in over, 6 months or something like that, if you'd like. Let's see here. Okay, I stopped investing in stocks and mutual funds 3 years ago, and now I have $15,000 in cash that I want to invest. I know markets are high. Should I do it all at once or start dollar cost averaging over the next few months? Most of the time, statistically speaking, if you take any period of market history and just like any random 10 years, any random 20 years, any random period of time, and you compare dollar cost averaging or lump sum investing, 7 to 8 times out of 10, you will make more money by lump sum investing. And the reason for that is because more often than not, markets are going up. And so if markets are going up, you want to get all your money in at the beginning. It only makes sense to dollar cost average if markets are going to be going down, because then you lower your cost along the way. And most of the time, markets don't go down. Most of the time, markets are going up. Now, in those periods of time, like the 3 times out of 10 or the 2 times out of 10, you would have done better by dollar cost averaging. And so statistically, the answer would be just throw it all in. If that makes you uncomfortable, though, ultimately the point of investing is to create wealth in order to create a better life for yourself. So if you're like, I've got a bunch of cash, and you're not going to be able to sleep at night because you're like, oh man, I just put all this cash into the market at the top, then don't do it. Dollar cost average, and just know statistically you're likely to be a little bit worse off, but it's not going to be a ton worse off. If you say, okay, over the next 6 months, I'm going to put this in and I'm going to do, let's say, I don't know, $2,500 a month across my portfolio every single month. It's like you're not going to be that much worse off, especially if you do daily buys. So if you're doing it more dynamically and you're like, okay, anytime there's a red day, I'm going to make some big purchases. I'm going to put $500 into the market anytime there's a red day. So if you're able to do it more dynamically, then that can be more fun, can give you a little bit of a lower cost overall as well. If you really want to get the statistically best returns by lump sum investing, but you want to be able to sleep at night, then hedge. All right. What parts of the US do you live in? Are there any areas that you think are worth moving to as a young person? I'm in Seattle area and I'm not sure if it's worth staying, although I do like it here. I don't know if that's a question that I have the experience to answer. So if I was in your position, let's see, are you young? Yeah, you said you're young. So if I was in your position, what I would probably do is look at my skills, like what am I doing? What are my interests, and like where do I want to go for my career? And then just find the best places in the country for that, and try and apply for jobs in those areas. It's usually going to be big cities. That's usually where the most career opportunities are, and just look at it as an opportunity to learn. The biggest mistake I see is people go to jobs for earning. Jobs are for learning, not for earning. You go to learn skills. And so you start a job in a career you're interested in a specific, whether it's marketing or finance or plumbing or whatever it is, and you learn a skill that will help you make money. And once you've mastered that skill, get a different job, whether that's a promotion or a lateral move or a different company or whatever. Get a new job that allows you to learn a new skill that is complementary to the skill now that you already have. So my first job as a stockbroker, I was able to learn a bunch of the things about the industry, just very general, I got my licenses and all that. My next role was a sales role. I couldn't have done that sales role without all of the inside knowledge. But that sales role taught me very specific skills. I was able to stack on top of those first skills that allowed me to make a lot more money. And so keep in mind, just always view jobs as for learning, not for earning. And that will allow you to take more opportunities, that even if you don't make more money in the moment, you're learning something that eventually you'll be able to stack together and make way more money in the long run. It's far more valuable to stack and compound skills rather than stacking and compounding little promotions and little raises by trying to work yourself up some ladder. So find your interests and your skills, go get a job find the places that have the most opportunities for those, and then go there and job hop in order to learn, not to earn. Okay. Next question. How do you pick your option, strike price, and expiration date? Mostly it's just a matter of doing the math. So you look at a stock, we'll go through a live example right now. Okay, so let's look at what's a good example here? All right. So let's say SLV. I was interested in making an options trade to profit off of SLV going from 46 back up to its high here of 49. Well, then what I have to do is I have to say, okay, well, how long do I think it'll take for it to get there? And let's say, I think it'll take up until, November 18th. So I think it'll take 1 week. So maybe I give myself an extra week. So I go to, Friday, November 21st as my expiration date. Now I have to look at the pricing of those strike prices. So we've got probably a 47 strike price and a 48 strike price and a 49 strike price. Well, if I think it's going to go to 49, well, by expiration, the 49 strike price is going to be worthless. So I'm not going to pick the 49 strike price because that doesn't allow me to profit off of the move that I think is going to happen. And so then I'm going to look at how much does a 48 cost. Now, if the 48 strike price for next, 2 weeks from now costs 75 cents, I'm spending 75 cents for the chance to make $1. So it's a 25% profit. Now that might sound like a good profit, but the likelihood of this move is it's not 100%. And so my worst case scenario is worse than my best case scenario. In other words, my total risk of loss is greater than my total chance of profit. So to me, that's not a great trade. So then I look at the $47 strike price, and maybe that's $1.50. And so that's better, $1.50 versus, no, maybe is that the same ratio? Okay, let's say it's $1 just for this example. Well, then I'm risking $1 for the chance to make $2. So my profit on that would be $1 because at expiration, the 47 would be worth 49. So there, I've got perfectly symmetrical risk versus my potential return. So I'm risking $1 for the chance to profit $1. Now let's say we look at the 45 strike price. Well, now we're in the money. So if it doesn't move at all, then I still walk away with something. I don't have 100% loss. I will have 100% loss if it drops down below my strike price of 45, but assuming it does nothing, then I have some built-in margin of safety there. And let's say that $45 strike price costs $2, which it wouldn't, but just for this example, let's say it would. Then that $2 would be worth, the 45. Well, that would still be worth 4. So that'd still be a 100% profit potential versus 100% loss potential. So on this one, then what I would do is I would look at that and say, if those were the real numbers, I'd probably look at that and say, you know what? There's not a trade here. Given what I think this is going to do in this time frame, there's not a good enough risk to reward ratio here for me. So I'd walk away and I'd look for another opportunity. So so that's the process I go through. Now, let's say instead the 48 was only, 25 cents. Well, then I'm risking 25 cents to make $1. That's a 4x return. That's a 300% profit potential. Well, that's a decent trade then. I'm risking $1 to profit, the potential to profit $3. Then that's an asymmetric trade now because the most I could win is much larger than the most I could lose. So if that 48 strike price was 25 cents, then I might take this trade. So that's the way I choose it. I'm looking for a really good risk to reward ratio, given what I expect the underlying to do. And that's kind of the key that most people miss. They just say, oh, I'm bullish, so I should buy calls, and I don't know where I'm going to buy them. Well, how bullish are you? Where do you think it's going to go? How bearish are you? Where do you think it's going to go? Because it's not going to move forever. It's not going to move an infinite amount. Where do you think it's going to stop moving? And then now price it out. Where do you get the best risk to reward ratio? And so that's the process very simply. Okay, let's see here. How do capital gains taxes work with options? They are short term. I think if you get leaps, those are long term. Let me double check on that. Long term capital gains with options. Yeah. Options are just taxed either as short term or long term, depending on how long you hold it for. And there are most options are going to be under a year. So most of the time you're going to be doing, short term capital gains on those. Thank you for the super chat, The Theo Gintor. Appreciate it. I don't see a question there though. I see a number one. So if you meant to ask a question, you can ask that now. Which branch of the government or the Fed has the most influence on the dollar? It depends on the time period that we're in. I think right now the Treasury is exerting more influence on the dollar than the Federal Reserve is. We're in more of a fiscal dominance type of period, meaning the Treasury, depending on their taxing and spending decisions, has more of an influence on everything, including the dollar, than monetary policy does. Monetary policy right now is having a fairly small impact on markets overall on the dollar. They're not really doing much, is why the rates are somewhat near a expected neutral rate. They're not 0%. They're not at 6%. And the balance sheet is now in a couple of weeks it won't be moving anymore. So they're exerting very little influence over the dollar with monetary policy. You mentioned several books in your last live stream. Would you post a list of books or specific topics that you'd recommend reading about? I would appreciate just a text post on your YouTube page. Yes, I've been meaning to do this for a very long time because most books I don't think are worth reading, but you have to read through a lot of books to find the good ones. And I've found a lot of good ones. So yeah, I'm going to put together a good list soon and I'll post it in an easy way to look through and use. Do you think Bitcoin will replace the global financial system? If not, why not? If so, in what time frame and what will be the catalyst? I think if it does, it will be very, very, very good for freedom, for prosperity, for growth, for limiting government intervention, and a lot of things will improve if Bitcoin does become used as money. It really just depends on people choosing it, though. Like that's at the end of the day what it comes down to. It's at the point now where governments can't really stop it if that's what people choose. And in fact, throughout history, that's never been the case. Like when any currency has collapsed and the governments go back to using gold, it's because the people have already gone back to using gold and the government needs purchasing power. So they have to use what the people are willing to accept as payment. So the more the government abuses the currencies that they control, the more incentive there is to look for alternatives. It's possible that becomes Bitcoin in the future. It's also possible that it doesn't. And it has a lot to do with how much governments abuse their currencies. It has a lot to do with the competition from different countries. Like if there is a lot of advancement and development with redeemable currencies redeemable in gold. So it's I don't know. I don't have a good answer for you, but I look at it like an asymmetric trade. If Bitcoin were to be used as money in the future, it would have to be worth many times what it is worth today in order to be the denominator for global transactions. So because of that, it is worth holding, in my opinion, starting off with a 5% allocation and then dollar cost averaging in along the way. Because then if it goes to zero, you lose 5% of your portfolio. If it becomes used as universal money, then it makes a huge beneficial impact on your portfolio. You're just counting the intrinsic value, not the increase in the extrinsic value. Yes, just to be conservative. So obviously you do want to take that into account if you're wanting to be super precise. Especially if you are choosing an expiration date that is a lot farther away than the amount of time you expect the move to happen in. So the move we were looking at in silver, I chose an expiration date that was, or, in my example, that was 2 weeks away because I expected the move to happen within, 7 to 10 days. So it's like, Well, by expiration, there won't be any extrinsic value. There will only be intrinsic value. So if I'm choosing an expiration date that lines up with how fast I think the move will happen, then you can't count in any time value because it'll be gone. And then alternatively, if you are going to give yourself, an extra month or extra 2 months, um, one like conservative shift that I like to make is still only counting intrinsic value, because then if the move happens quicker and there is still time value, then I hit my profit target sooner and we don't need the full move to happen for me to exit. Because once I enter the position, I'm setting a good till canceled limit order to sell at the profit target for the option. And so if there's still time value left and the move happens quicker, then I exit sooner. We don't even need the full move. In case I was a little bit off in how high it'll go or how low it'll go, then that's just, I get to get my money out faster. All right. Thank you for the super chat. And I don't know how to pronounce your name because it's in a different language. What do you think of Bitcoin? Is there a chance to drop to 93,000 before the next bull run? There's a chance there is no next bull run. Nothing is baked into the cake. If it was certain, it would be much higher already because certainty is priced into the present. So is there a chance that it drops to 93,000? Absolutely. Absolutely. I think the holding of support around 100,000 is a good sign, but there's absolutely nothing that would prevent it from dropping more before it goes up, or dropping more and then not going up. It's just a matter of, are buyers willing to pay more and more for it? And are sellers unwilling to sell for lower and lower prices? Is those two things line up, then yeah, the price goes up. If those two things are the opposite, then the price goes down. How do you pick the time interval for your candlesticks? It seems the moving averages vary significantly. If I change from 5 minutes to an hour to yeah, I mean, oh yeah. So, okay, guys, moving averages are tied to the time period you're looking at. So let me show you what I mean. Okay, so let's go to SPY and let's put up the 50-day SMA. Okay, so an SMA stands for simple moving average. So the length is 50. So it takes the last 50 time periods and averages those together into a price point. You can see the time frame here says chart. So if we are on a daily chart, then the 50 SMA is going to be the last 50 days prices, closing prices averaged together. And every plot along this point, then it turns into a line. But if I go to a weekly chart, now it's a 50-week simple moving average is the line, because it's taking each candlestick is a week. So it's taking the last 50 weeks. If I go to a 1-minute chart, this is a 50-minute simple moving average. So that line is going to just be calculating off of the time period of the candle that we're looking at, unless you lock it. You can lock it right here. If you change the time frame from chart to something else, you can lock it. But that's important to know that's how that works. In terms of the time frame that I'm looking at, markets are fractal. And so if I'm trading on the, if I were to day trade, which I don't, but if I was going to be day trading, then I'm going to be looking at the minute chart. So then it would be appropriate for me to be looking at the 250 simple moving averages for the minutes. That would be the most appropriate moving averages for me to look at. It doesn't matter what the 200-day moving average is if I'm day trading. And so you want to be looking at information that has the proper signal to noise ratio and volatility given the time frame you're trading. Now, if I'm swing trading every couple of days, couple of weeks, couple of months, it doesn't matter what things do on an intraday basis. So I want to look at the 50-day, the 200-day maybe. And so you're going to look at the chart based on the time frame that you are investing or trading for. So if you're choosing a long-term investment, then yeah, maybe you're going to be looking at a weekly chart so that you can see, okay, I don't care what things do on an hourly basis. I want to see what the long-term trend is here, because I'm trying to pick a stock that I'm going to be buying for the next 10 years. So, I'm looking at a chart that goes back to, 2006. So I'm going to look at weekly candles or maybe even monthly candles because that's going to give me a little bit of a more, eliminate a lot of the noise from the time period that actually matters to me. All right, guys, I'm going to do one more question here and then we'll be done. Let's see. All right. Let's see. Let's do. What do you think about the fact that it's possible to make an infinite number of cryptocurrencies? And if we could make an infinite number of chemical elements, I doubt gold would be as valuable. Um, let's talk about the cryptocurrency one first. So, if you are going to make a new cryptocurrency and you want it to compete and you want it to, Bitcoin's the biggest. So, let's say you want it to get as big as Bitcoin. Well, you're going to have to make it different somehow. Because if you make it identical to Bitcoin in every way, and it's just a little literal copy and paste, then nobody wants it because I want the real Bitcoin that's worth something. I'm not going to buy something that's identical that's not worth anything in the hopes that it becomes worth something in the future. So you're going to have to change it. And Bitcoin was not the first cryptocurrency. There were many attempts, just like there were many attempts for different like social media companies and all that. But if once you get the ingredients right, this is almost like a in a simulation where it's like a bunch of variations are tried because a bunch of people try and do the same thing. Eventually, it's inevitable that some of the right ingredients come together in the right way. That's the thing that becomes successful and takes off because that ends up being the thing that just you couldn't see it in before it happened. But in hindsight, it's like, okay, yeah, that's got all the right mix of ingredients. That's the one that people want the most, and that's the one that works the best. Um, and that's kind of how Bitcoin started. It was just one of a number of different cryptocurrencies that had been developed by a bunch of different people over a long period of time, and it happened to have all the right ingredients and characteristics and limitations that it allowed it to grow organically rapidly because that ended up being what people wanted the most. And so if you're going to differentiate yourself from Bitcoin and make it different, you're going to have some sort of a trade-off. And as far as it seems, all of those trade-offs are make it worse, whether it's from security, whether it's from control, whether it's from speed or efficiency or whatever it is. The market has spoken, and it's obviously possible that something in the future changes that. But network effects are pretty powerful, and it seems unlikely at this point that something else is going to be able to identify a new trade-off that people are willing to accept the worse part of it, enough that it's able to overtake Bitcoin. Now let's talk about gold because it's a very similar thing. It's like there's a bunch of elements. Nobody by declaration just decided gold was going to be used as money. It naturally and organically emerged as money because of its properties, because of its limitations. It's like because of the chemical nature of gold, it's indestructible. It's impossible to create, like outside of a dying star or a neutron star blowing up or whatever. Like they've created gold in the colliders, but it's like the amount of cost and energy to make like one gold atom is like astronomical to the point where it's like it would be much cheaper to build an arm, to build a bunch of massive rocket ships and go up and mine it from asteroids. And that is exponentially more expensive than just digging it out of the ground. Like there's a lot of gold that's in the ground that's just not profitable enough. We know it's there. It's just not profitable enough to go in and get it. And so gold emerged as money because of its properties that make it useful as money. Bitcoin emerged as the dominant cryptocurrency because of its properties that make it useful as money. The fact that it's indestructible, the fact that it's easily identifiable, the fact that it is it doesn't rust and it doesn't decay, and it is easily malleable, which makes it easily divisible for smaller and smaller transactions in a deflationary environment. So a lot of the characteristics about gold that gold have just naturally and intrinsically allowed it to organically evolve to be used as money for thousands of years. And it seems Bitcoin is the same way. So, so that's the answer there. All right. I got to run. Lots of great questions. Appreciate you guys. Thanks for watching. And we'll see you next time.